Hey guys, this is Chris Mincola with Mincola Group over at West USA Realty. Hope you all had a great Easter weekend and just wanted to check back in and get you a new housing report. We took a little break there for the weekend and part of the week, so we're back at it. Now, I wanted to share with you what's going on in the housing market here locally in the Phoenix area, but nationally too, and where we are is pretty much what we've been telling you for months now. Let me just go ahead and share my screen here with you so that we can dive right in. All right. Okay. So starting with this is MBS Highways, Barry Habib's publication. We follow Barry Habib because he is typically correct on everything. And very differently than what you see in the mainstream media a lot of times from a lot of people. I'll get into that more, but typically we heard things like inflation was transitory, but then it wasn't. And we already knew this, and we kept reporting on it through our podcast here. And I just wanted to make sure that you kind of really realize across the country, their survey showed that right now, multiple offers are at 43%. That's pretty good. Okay. They kind of break this down into different areas of the country. I'm not going to get into this in depth, but I just wanted you to show that. I just wanted to show you that, we're either mostly at multiple offers on listings or near asking. So, at 38% normal, near asking price. So, it's still a kind of a steady, normal market in most areas. Now, I understand some areas have been hit harder than others with what's gone on in the last year or so when inflation just went bonkers along with interest rates in the last year or 2 years. But, we have to kind of look at what's the trend, where we headed, what are the data points, and what's the critical path to get us, and when are we going to see these lower interest rates? Well, guess what? We're starting to see them already as forecasted. Inflation pretty much peaked. That doesn't mean there's no inflation. Okay. It doesn't mean things don't cost a lot of money. And it doesn't mean that the Fed and the government have really kind of maybe been behind the eight ball as usual and lagging on all the information and solutions. And not quite sure that they've kind of figured out the correct way to go on the solutions, in my opinion, but that's a whole nother story. So if we go into where we are, where we're headed and everything, we were just, a couple months back, it's been pretty rocky from the holidays, the beginning of the year, first quarter. But, we saw, we even saw over 7% interest rates at one point. So right now, we've got clients all the time buying, selling, whatever. And right now, not doing any buy down stuff or any crazy things. We're seeing people not with the best credit in the galaxy, in the fives, in the 5.7 to 5.3. So that's just this week. Okay. And again, things change by the day and the hour and the week and the month and all that. But that's what we're seeing anecdotally. And we're starting to see this around the country. And again, it does depend on which lender you go on as far as the terms, the costs, the fees, all that. And, I always like working with a mortgage broker just because they're going to shop the best rates and then go from there. And that's what we do. So anyway, we can certainly help you with that if you have any questions. But I thought this was very interesting, very good, information that's been collected straight through from last year into this year and compiled. So here's where we are right now. I'm just going to kind of click through these really quick, and then I've got some other slides I want to show you. The the turning point for labor and housing. Now, why is labor important? Labor is important because this whole thing with higher inflation due to economic policy, due to COVID spending, due to modern monetary theory of printing money, and overprinting of money and those sorts of things have gotten us to where we are here right now, whether you agree with those philosophies or not. That's the bottom line, and there's just no other way of getting around it. So, when you are trying to transition from one energy source to another, for instance, there's going to be some pain there, and when and it's going to affect pricing on everything. When you overprint money for all the emergency things that we had for COVID, whether you agree with any of that or not, it creates inflation. Okay. And in the meantime, while things were good there for a little while, in the very, let's say, last couple of years with housing, and things were going steadily upward like crazy. If you own any properties, we saw a slowdown because that inflation went up, and whenever inflation goes up, mortgage rates go up. And we see that what the Fed is trying to do is tame inflation, so they raise the federal funds rate. Now, people get this confused with mortgage rates. It doesn't directly affect anything to do with mortgage rates. It's basically what it costs the bank to get, to get the money, and get it to you, and then they charge their rate on top of that and their fees on top of that. So whether you're going to buy a truck or you're going to use credit on your credit card, all these rates go up. Now, that indirectly affects us due to, all the different factors that come into play. But it's when you hear them say the federal rates are going up, that doesn't mean interest rates are going up. And typically, the mortgage industry already knows what is pretty much going to be happening, and it's already been baked in to the cake. Okay, they've already got that figured into their rates. All right. So without going down the rabbit hole there, the reason why we want to look at the employment numbers is because this tells us whether or not the Fed raising those funds rate have, gone far enough or too far or not far enough. So because when you do this and you kind of restrict people's spending on credit, basically, whether you're a business trying to buy something on credit or buy a new product or do product development or buy a new factory or building, all that comes into play, right? Usually people are leveraging all these things. They're not, most people or most companies are not going around buying stuff cash, right? That's just kind of the world we live in. So those are all inflationary factors when you're buying things on credit, whatever it is, from the truck that you're buying or the car, all the way up to those commercial properties or those business endeavors. So by doing this raising of the Fed's fund rate, it slows the economy down, which means you're going to end up slowing employment down. So this is just one indicator that we look at. And by looking at these numbers, initially we had, everything's wonderful, everything's great, as far as jobs go. But since people are getting more jobs, then inflation's going to keep going up. Well, that really wasn't the case, because I'm just going to read this bottom line here on this. Despite the strength in these headline points and the headlines you saw in the mainstream media, a deeper look, and I've gone over this before, but a deeper look at the data shows signs of weakness in the labor market. That means that taming of inflation, which tames employment and product development and hiring, is happening. It's happened. Okay. So, and they were bringing in a lot of numbers that had to do with seasonal stuff in the beginning of the year and end of the year, of the first quarter and fourth quarter of last year, seasonal employment and some other factors. So the numbers, they did it that way maybe to make things look better, but they really were not in reality. So when you dig deeper into the numbers, remember, a lot of this stuff too is also generated now by computers and all this stuff. But if you don't really have someone who understands stuff like with MBS Highway or with people who are involved in the industry that really understand this at the ground level, at the street level, in reality, okay, then not with what the elites are saying, then you really have to kind of look at the whole picture. So it says here, leisure and hospitality accounted for 72,000 new jobs. This sector has been a huge driver of job gains after the massive losses seen during the COVID pandemic. So basically, all the people from the pandemic, they kind of went out of the workforce and then they came back in, and it kind of, made the numbers look like great, but they were really the people that were already there before. Or if you're looking at the tech sector, maybe they overhired during the tech sector during COVID, for the tech sector in order to handle all the things that were going on virtually and digitally and all that. But then some of that's been pulled back, along with the taming of inflation, which is also taming the tech sector too. Then by raising these rates, we saw the bank collapse, because what they had bought before now costs more to unload or invest in. So that slowed the banking sector down. And that is what is going to basically, I'll get into this, is going to head us right into a recession. But it all started with, the overspending with the COVID stuff. And it all started with the idea of what our energy policy is going to be, because energy, you're dealing with your utilities, you're dealing with, your vehicles cost more now, you're dealing with, factors of, food, and what kind of, fertilizer, down to fertilizer, and what it costs to transport everything on the planet, ground and air, all that stuff just costs more, and then you pay for it. We end up paying for all this stuff. Whether it's the bank collapse or whatever, you pay for it one way or another. And inflation is the harshest tax in the world. Okay. And when inflation goes up, rates go up, interest rates go up, as far as mortgage rates. Okay. So when we're looking at mortgage rates and then what this has to do with the economy. So the bottom line here is that we saw that now what's happening is those people got hired back. But as we read through the article, we now see that, hey, the hours that people are working have been lowered. Okay. So, what that means is we're going to see, that's kind of an indicator that with the lower hours people are going to be working, it's an equivalent of a job loss. Okay. So, and I had that point in here and I can't find it right now, and I don't want to take a lot of time on it, but anyway, I'll be posting this all up on social media. I'll send this out in our weekly emails. If you want to get a copy of this whole report, great. Here's just a couple other headlines I wanted to show you. Home price growth accelerated in March as competition heated up over record low new listings. Okay, so we've got low inventory and we're seeing that things are starting to heat up. Mortgage applications increase in the latest MBA weekly survey. In other words, these are all trends and data points that we can see. Where are we headed? Are things really developing like we thought they were going to, as we've been forecasting? Not the mainstream media and what they've been saying, because, they've been saying the housing market's going to crash since the last crash. Okay. And I'll show you a proof of that. And they've been saying, this inflation was transitory and blah, blah, blah. Well, after 2 years or a year and a half of inflation, it's not that transitory. Okay. So cheap gas and food provide some relief from inflation. So we see these inflationary factors are finally coming down. Did the Fed overdo it? I think so. With the banking collapse, that's one that we see with the real numbers in the labor market. That it's not looking good. People are starting to get reduced hours. So, but what happens when what happens when we go into a recession? Fed expects banking crisis to cause a recession this year. So, what does that mean? Well, in the housing market, that's actually a good thing, and I'm going to get into showing you why. So, here's just some slides. We know new listings are down as far as supply, 21%. We know Buyer demand has been down up to this point, but it's starting to increase. Why? Because mortgage rates, people were hibernating. People are like, well, I've got a 2 or 3% interest rate over here. Why would I want to go and sell my house and buy something else? Or why would I want to go buy something? I'll just wait for rates to come down. Okay. But there's an opportunity to kind of jump in when other people don't, if you can afford to, right? Because if prices go down temporarily because of the fact that there's not as much demand because of the higher rates and inflation, then you've got a chance to get in there and get a home at a great dollar amount, right? Then there's the buy down programs where you can have lower rates and even have the seller pay for it in the slower market. But we're into the busy season now, and rates are dropping at the same time as inflation is easing a bit. Now you might say, Chris, yeah, but if people are losing their job, who's going to be able to buy a house? Well, yeah, let's say, 1 million or 2 million people lose their job. Okay, that's a fair point. Great. Well, nobody wants to see that, but that's just kind of what happens with this taming of inflation, right? So what happens? Well, we were over 7%. Like I said, now I'm seeing people getting, rates this week, in the mid fives. So that means, for every 1% drop, Barry Habib will has explained this before, and I've sent out videos and posted videos of him talking about this. But for a 1% drop, that 1% drop, okay, let's say from it was like 7.2 to 6.2 in interest rates for mortgage rates. That 1% drop means 5 million more people can now buy a house, or over 5 million actually. So let's keep going here. But there's a few things that happened that could kick this housing market back in gear, as we've been talking about. Demand is what we need, right? So if buyers and sellers knew the mortgage rates were coming down, would that get them off the sidelines? Buyers, sellers now have perspective on things. And in reality, where rates are now is really kind of a historic norm, actually. But we just got spoiled with those 3% interest rates, right? Or lower sometimes, right? So, we were talking a few months ago where we had, like, in August of last year, we had this little dip where it was around 5% for like a couple of weeks. We saw a stampede of people come into the market in our area and across the country when that happened, right? So, buyers and sellers and buyers. So what we felt like the tipping point was around that 5% mark. Once we get down to we're already seeing that with the seasonal stuff happening too, of course, but we're already seeing that explode. So here's what just happened to mortgage rates. We talked about them. That the headline CPI year over year, the inflation rate tumbled 100 basis points from the previous month, 5.0 from 6.0. This gain was lower than expected, though the census estimates were pretty close at 5.1. This now makes 9 straight months of lower inflation rate from 40-year high in June of last year, which was 9.1%. This month over month drop is this metric. In this metric is also by far the steepest we've seen in this decline. So mortgage rates follow inflation. Mortgage rates versus inflation, okay, over all the way back to 1971, inflation goes up, mortgage rates go up, okay? Inflation comes down, mortgage rates go down, okay? So now look at purchase applications, okay? We see Google, first of all, with Google searches, we see homes for sale were up 44% just in Google searches, okay? I know that's not closings, but just activity, right? What are the trends? Where are we headed? What are we expecting? What are the data points? What's the critical path? What are we looking for, right? What's the trend? Mortgage application volume responds quickly to recent rate drop, okay? So we see mortgage applications increased last week for the 5th time in 6 weeks. The Mortgage Bankers Association said that the market composite index measured mortgage loan application volume increased 5.3%. on a seasonal adjusted basis compared to the previous week, and was up 6% before adjustment. So guys, again, demand, right? Rates drop, demand goes up, okay, because inflation is coming down. This is from Realtor.com. We see more buyers viewing listings on Realtor.com compared to the average week in 2022. So we're actually up from last year, 6.4% higher than last year, same time. Shiny new listings are getting multiple offers and selling fast. And again, those Google searches. So we're seeing, we're seeing, on average, at least about 3 offers on a property. Again, if it's not a broken down, fallen over, right? If it's something that people are looking for, if it's trendy or something that is got some good features to it, and it's cleaned up and shiny and looking showroom ready, we're seeing multiple offers on resale homes, okay, in our area, and they are across the country, like I mentioned earlier. We had one this week in our office where we had 10 offers on a property. So guys, the time to sit on the fence, I think, is over, because as the rates have dropped and as they continue to drop, which we're going to see a big drop when shelter costs get caught up by the May 10th date of the Fed's meeting, okay, we're going to see a huge shift. So when we say buy now, we're not just saying it because we want to make sales. Look, if property values overall for us in the industry, if property values drop 100, 200,000, yeah, people are going to lose equity if that were to happen. But guys, wouldn't it make it easier for us to make money? So what I'm saying is prices have dropped. They dropped as much as they're going to drop in the Phoenix area in December from Cromford Report, our local gurus here. And they've been steadily, the first month or two was kind of like, but then it was a rocket ship when all the contracts that properties went under contract in the first couple of months actually closed. We're seeing now, it's all coming ahead, right? Because inflation came down, rates came down. And again, it's not to say there's no inflation. It's not to say things don't cost too much. It's not to say that you wish the house was $100,000 less than what it is, but you can get a good price on a home now. You won't have a payment for 2 months. It's a good time to sell a house right now. It's the best time of the year, and move on to your next property. And then you can refinance later with no out-of-pocket costs, okay, when rates drop even more dramatically, okay? But get into that game now, because then you're not, you're already dealing with multiple offers. What's going to happen if rates drop another, 50 basis points in mortgage rates, or more? What do you think is going to happen? It's going to be a stampede, okay? A stampede. So fewer homes that are listed are getting snatched up fast because people are just sitting there like, what do I do? What do I do? Should I wait? Should I go? So, and I get it. I'm not saying that those not are not unfounded, and waiting. But according to Redfin, here, and among the homes that go under contract, nearly half of those are doing so in 2 weeks. Okay, that's up from just a quarter at the beginning of the year. Today's supply of homes for sale could take 2.8 months to sell at the current home buyer consumption rate. Again, this is across the country. A sharp drop from a 3-year low of 4.5 months recorded at the beginning of January, and up from a near record low of 1.9 months recorded a year ago. Okay, so supply. What about supply, Chris? Well, here are also a few things that are happening to suggest an unlocking of new inventory. Home selling sentiments improved, and in that survey, that MBS survey, where they mentioned that in there, but the percentage of respondents who said it was a good time to sell home increased 54 to 58%, while percentage who say it's a bad time to sell decreased from 44% to 40%. This means that the difference between those who are thinking it's a good time versus those who think it's a bad time has increased by 8% points, percentage points compared to last month. Okay, that's just in 1 month. This sentiment towards selling conditions may encourage more homeowners to put the homes on the market, leading to an increase in inventory as of March. Newly listed homes lag behind all previous years in our records. Okay. Moreover, the report found that the number of people who aren't worried about losing their job in the next year went up from 73 to 78%. At the same time, the number of people who are worried about losing their job went down from 24 to 21%. This means that the difference between those who feel secure about their jobs versus those who are worried has increased by 7% percentage points compared to last month. This increase in job security sentiment may lead to more homeowners feeling confident about their financial stability, considering buying a home or selling a home. However, the latest unemployment trends show some signs of cooling in the job market. Okay. In March, companies added, and then it goes into the jobs thing we kind of already talked about. So Realtor.com, again, more what's the trend, Chris? Where are we headed? What's going on? What are the indicators? What are things telling us? Permits for new homes rose 13.8% from January, driven by a 7.6% increase in single family units. At the same time, permits were 17.9% below last year's numbers. Meanwhile, housing starts also advanced 9.8% from the prior month. Okay, so those are some big gains. But remember, prior to last summer and into the year before that, we were in an anomaly time, anomaly year where, but builders don't want to overbuild because that's what got us into the housing crisis before. They overbuilt, and then we had crazy lending practices to unload those properties, and then people defaulted on them. Okay, that's what led to the crash. So, 1 point, this is from the prior month, to 1.4 million annualized units as single family activity picked up. Starts were 8.4% lower than a year ago. Completed homes ready for sale increased 12.2% from January and were 12.8% above February of 2022. Importantly, the pace of the single family homes completion was 1.1% above the prior month, as the South and West saw double-digit gains in numbers of new properties. So there's supply coming. The best time to sell, according to Realtor.com, is April 16th. That's this week coming, right? April 16th to the 22nd. That's the 2023's peak week to enter the market nationally. Okay. So again, some people, some areas are a little different depending on when you go to school and, get out of school and all that, because people usually want to move when school's out, right? So, let's see, we've got fewer sellers than the average week, 9.3%, higher asking prices than at the beginning of the year based on typical seasonal trends, okay, up 48,000. Faster home sales than the average week, okay, 18%. And then we see 16.4% more buyers viewing listings on Realtor.com compared to the average week in 2022. So all these indicate that supply and demand are going to go in the favor of the market, and the equity gains are going to be there too because of the lower rates, the higher demand, and all that. So our local Cromford Market Index is, this was actually a couple days behind, but it's actually at 140 as of today. That means we are in a seller's market in the Phoenix area. Between 90 and 110 is a balanced market, or 100 being totally balanced on their index. 90 to 110 is balanced, 100 being completely balanced. So over 110 is a seller's market. This has been gradually going up, as you can see on the chart. So we're, not crazy seller's market, because that chart would have been, like almost 500 in the anomaly time that we were dealing with over the last couple of years. So, Shelter costs are lagging. They're usually lagging by several months. Actually, the total core inflation on this is the total would be 43%. So that's a typo there. But anyway, we're seeing that shelter costs have come down, with that means, some of that's lagging too, because some of it's got to do with rents and new builds, things like that. So when we look at the rent, we see that the shelter costs have come down, but the longer we wait, right, stuff's going to start going up again. So let's look. Lawrence Yun, the National Association of Realtors chief economist, said calmer inflation means lower mortgage rates eventually. The 5% consumer price inflation in March is steady improvement from 9% last summer, 8% in autumn, 7% during Christmas, and 6% in the early months. So again, agreeing with the fact that inflation already peaked and rates are coming down. Okay, to kind of bottom line this. There's kind of a market review for us in the whole Metro Phoenix area for the first quarter. And we saw that, everything's trending in a good direction. What's going to happen if we have a recession though, Chris? Well, remember, 2008 was actually a recession due to the housing market. Okay. All other recessions, okay, actually means, number one, when we have a recession, when we have a bad economy like we're in now, we have lower interest rates. Ta-da, we're getting lower interest rates. Okay. So yes, some people may lose their jobs, but when the rates drop, those people who get rehired later or already own their own home, have the equity, are in a position to sell, buy, or just buy, they're good, and more of them will be available, so to speak, in the housing market. When it pertains to housing, okay, just we're looking at housing, okay, they're going to be buying homes, okay, so or they can qualify to buy or afford to buy once those rates drop. So the mortgage rates and recession, what does this mean as far as the market is concerned? Well, we see that mortgage rates, drop, and housing does great during a recession and stays strong through a recession as far as prices. Okay. When we hit recessions, rates go down and equity goes up. Again, 2008 was a little different because that was a housing market recession. Okay. If you're looking at the mainstream media, here's how much you would have lost going back to 2015 to 2021. If you were to start with a $300,000 house and those equity gains you would have lost, from all the talking heads on the mainstream media. Okay. The ones that told you that inflation was transitory. Okay. So should I buy or rent? Well, Albert Einstein, pretty smart guy, said compound interest is the eighth wonder of the world. Should I buy or rent? Well, it's kind of, a no-brainer when you look at the numbers and you look at first year of buying versus first year of renting, and over a 9-year period, what you're probably going to end up paying, between now and then in rent. And when you look at principal and interest on buying, and then you add up all the other, factors for, insurance, repairs, all that, monthly payment and cash flow difference. We look at, your appreciation gain, you got tax benefits, excuse me, tax benefits, amortization gains, that's where you're paying down your principal and all that. So, once you pay your commissions after 9 years, if you were to sell your house based on a $593,926 future value, puts you at a pretty good gain, right? Your net gain is going to be about $205,000 with all those compound interest. You got your equity that goes up just in general. Housing prices go up. You're paying down the mortgage. You're getting the tax benefits and all those sorts of things. So you were born to be many things. A renter is not one of them. You were, supposed to be, an owner, guys. So What I will say is, let me get out of this share, is if you have any questions at all on any of this stuff and where we are, I think it's a great time to sell a house, buy a house. It's the time of year. The rates have dropped. Again, we were over 7%. We're now seeing, again, this week, again, things can change and go down more, or maybe, stagger around a little bit. But by May 10th, those shelter costs catch up, which they should by next month, in the numbers, in what's baked in. We're going to start seeing, rates continue to drop, May, June, July. And again, they've already gone from over 7, and we're seeing rates in the into the 5s. Now, with government loans, you may even see them closer to 5, like FHA, VA. You may see closer to 5 or even in the 4s, depending on the day and the week. Okay. Anything can change, guys. Anything can change, but that's what we're seeing right now this week. If you have any questions at all, 480-788-8569, or you can email us at home@mincolagroup.com. Check us out at mincolahomes.com and mincolagroup.com. We'll see you guys next time. Make sure you follow us on YouTube and Facebook, and under my name on Instagram, and we'll see you guys next time.